Welcome to GRE. I'm your host, Keith Weinhold. The real estate market is slow. When this happens in a cycle, what does it mean to a real estate investor? What type of return can you really expect today? I'll tell you exactly, and you'll be surprised. Learn more about new build properties and why investors often prefer DSCR loans over conventional loans today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. I'm your host, Keith Weinhold. Yes, America's favorite shaved mammal on a microphone is back with you for another wealth-building week. Just a talking primate that's heavily mortgaged here. I'm also a landlord still waiting for a security deposit from back in 2018. Oh, I'm so into self-deprecation today that I forgot about the place names. Hitting you from Dover, Delaware to Andover, Massachusetts, and across 188 nations worldwide. You're listening to Get Rich Education. There's a realization that can sharpen your investor focus when you think about the fact that, in a sense, how little time you are allotted in your life. It's something that I've thought about more. You're only given about 30,000 days. That's the typical lifespan of a human being, and that goes for both shaved mammals and others. Well, you've already spent thousands of your 30,000. The question is, what are you doing with the rest? At some point, people understand, or they better, that they need to go out on a limb. There are people less qualified than you living the life you want to live simply because they chose to believe in themselves. And really, that's the moment everything shifts. Belief, it's not a feeling. It is a decision backed by action. Too many people learn this lesson the hard way. They discover, often too late, that relying on one income stream is the most dangerous financial plan of all. A job can vanish. Federal workers found that out amidst a government shutdown. A business model can change. AI can intrude. A paycheck can stop. But when you own assets that pay you month after month, no matter what you're doing, you slowly begin to untether yourself and move toward freedom. And here's the truth about pain and money. Poor and middle-class households work for money, so to them, that's why every dollar spent, it feels like a little loss. It can even hurt. And that is why they hesitate even on opportunities that could change everything. The wealthy, on the other hand, own assets that pay them, so therefore every dollar spent feels like a seed because it grows. When you own enough income property, you can move away from constantly asking yourself, can I afford this? And start asking, what will this investment earn me over time? This mindset shift changes everything at that time when other people's money starts working for you, not the other way around. And here's the thought experiment I use. Take the hourglass of your life and flip it. Watch the sand fall. That's time. 30,000 hours 30,000 grains. That is time, the one resource that you cannot get more of. So every day you delay prudently investing, the sand does not pause. It just keeps flowing. But you can choose how that time compounds. The sand that's left over and hasn't fallen through the neck of the hourglass yet, that is your opportunity to build multiple income streams from real estate, from ownership, and from leverage. It is your chance to replace anxiety with, well, autonomy. Every family with generational wealth can trace it back to one person, one risk taker who decided to stop trading hours for dollars. They believed in ownership and control. They believed in themselves. They acted before the sand ran out. If you've already started real estate investing, well, then you've already begun to break that cycle. If you've done it for a time, you're going to have more time, more income, and more options than you had before. That is worth celebrating and scaling. Because the best time to start was yesterday, and the next best time is before the next grain of sand hits the bottom. Later today, I'll talk about taking this sentiment and moving it towards something very specific and actionable. Now, in this era, the real estate market is slow. That is in terms of transaction volume. There just aren't as many sales. Sometimes this whole thing feels more sluggish than Jabba the Hutt after Thanksgiving dinner. 5 million is a typical number of existing homes sold every year in the U.S. 5 million, that's normal, that's baseline. During the pandemic frenzy, it reached over 6 million, and now it's about 4 million. That's why I say that housing transaction volume has slowed, and appreciation is only about 2%. That's below historic norms. And rent growth is like barely doing push-ups. It's 2 to 3% in single-family homes. Volume, now it has picked up a little here lately with lower mortgage rates, and so have home prices. Redfin now tells us that home price appreciation is 3%, but most outlets say 2%. Some analysts that are more optimistic than me call today's housing market healthy. They don't call it slow. And why is that? Well, it's the healthiest it's been since COVID because now you have a good balance of buyers and sellers. The real estate market isn't so miserably deprived of inventory like it was back in 2022, in 2023, but I am going to go with slow. Now, as you know, I coined the phrase real estate pays 5 ways back in 2015. But how exactly does that hold up in today's slow transaction market? Could an income property buyer's return even be disappointing now? Well, let's do it. Let's determine what you can expect if you purchase an investment property here in these slow market conditions. We'll determine your total rate of return in year one. And this will be sort of like dating someone. That's not the first date, but to really get to know them, to know if they're potential spouse material, you want to see them at their worst and be sure that they look good on their bad days. So let's just be conservative and use 2% home price appreciation. Say that you buy a $200K single-family rental now. A 20% down payment means $40K down. Sellers are willing to give you concessions now. Say that they're going to pay your closing costs because the $200K that you're paying is their full asking price. So it's your terms and their price. We'll say that you don't get any cash flow. The rent only covers the expenses exactly. Okay, so we're really painting on a not so pretty picture here, it would seem. Here we go. In a slow market, the first of 5 ways you're paid is that erstwhile appreciation. Your property only appreciates 2% from 200K up to 204K. Not so exciting until, of course, as we know around here, you realize that your return is your gain on your skin in the game. Your 4K gain divided by your 40K down payment gives you a 10% ROI. There it is. Leverage didn't just show up, it brought donuts. 10% just from the first of 5 ways you're paid. The second way is cash flow. Say that rent minus your 160K mortgage payment here and your operating expenses, that merely breaks even, like I was saying. So 0% additional return from cash flow. And before we add on numbers 3, 4, and 5 to get your total rate of return in a slow market, let's take a moment to check on Java. How's Java doing? Java still hasn't gotten up from that heavy Thanksgiving dinner. It's still a slow market. We've confirmed that. We're going to continue. The third way you're paid, as any GRE listener knows by now, is with that ROA, return on amortization, also known as principal paydown. With a 7% mortgage rate in your 160K loan on this property, an amortization table shows you $1,625 of tenant-made principal paydown. Divide that by your 40K down again, that is another 4% return. All right, so you add that to your 10% from leverage depreciation, and you've now got 14%. Next is your tax benefit. It's a 150K structure value, not the full 200K because raw land can't be depreciated. Multiply that by 3.6% depreciation. That means you've tax sheltered $5,400. That is like a phantom loss that you get to show the IRS. Just a little more math here, and this is as far as you have to stretch it in visualizing numbers in an audio format. At a 24% income tax rate, that is $1,296 saved on 40K down again, another 3% for you, and your running total is a 17% ROI. Before we get to the last one, which is inflation profiting. Not inflation hedging, which almost everyone mistakenly says in real estate investing. It is inflation profiting. Your 160K loan gets eaten by $4,800 at a 3% inflation rate. Divide it by 40K down, and inflation is usually the villain. Now it is the hero. You've got another 12% from inflation profiting, and here's the sum. In this slow market, your total year one rate of return is 29%. And you're like, my gosh, did that really just happen? Now, you might want to skip back on some parts of that to help make it crystallize in your mind. I've got to tell you, before I ran these numbers in this slow market, with this 2% appreciation, and even assuming zero cash flow, I thought your total rate of return would be in the low 20s, not this high, not 29%. The numbers don't lie. They just don't get enough attention on CNBC. Now, I did use shorthand and simplify. You would also have to adjust your 29% for inflation, just like you do for any investment. So then about a 26% inflation-adjusted return for you. Wow. And if you want to know more about what I just used shorthand on, you can always watch the 5 videos on the 5 ways real estate pays for free at getricheducation.com/course. That's getricheducation.com/course, the most valuable video course you'll ever see on real estate investing. But a huge investor lesson here, an epiphany today, is that it does not take a high growth market to build wealth, even when it seems like real estate's half asleep. It can still work. 5 jobs for you. We could be near the nadir of the cycle here. Appreciation has picked up in recent months with mortgage rates being lower than they've been in a while. But even when appreciation and rent growth slows, now you can see that the ROA, tax benefit, and inflation profiting just keep working overtime. The bottom line here is that income property still pays a lofty 29% if you buy today, even in a slow market. And this is at a time when investors, a lot of them don't know what to do with their money. since every market type seems to be near an all-time high and people don't want to buy in at those high levels. And savings accounts pay you less than a gumball machine. Owning investment property proves its resilience. I mean, this is why we do this. It's kind of like stocks can party with a surge in an upcycle, and then they can bust and boom and bust and boom. But all the while, instead of partying, real estate just keeps its head down and works the night shift for you. Your wealth quietly compounds in the background while the rest of the world panics or debates interest rates on LinkedIn or something. All right, well, with that in mind, where can we take advantage of that real estate return and expect to do even better with it, even if the market did stay slow? Well, builders have unsold inventory in places like Texas and Florida, like I mentioned before, and to a lesser extent in parts of the West as well, but the prices are too high out in the West for a cash flow investor. So today, you can buy at a discount in a way that you absolutely could not during the height of the pandemic. A guest and I are going to talk about a specific opportunity in today's market and then how you can exploit it. The National Association of Home Builders has even noticed that home flippers have switched gears, and increasingly what flippers are doing is instead buying new build properties and then renting them out, because new builds have lower upkeep costs, come with a lower mortgage rate, because the builder's buying it down for you. They have lower insurance, and they attract a better quality tenant that stays longer. Even if the HVAC did break, that's okay, because new build homes often come with a warranty. The smart money knows that new build is where the opportunity is today. That's something that I've discussed for a while here, but today we're getting more actionable. CNBC let us know that the C.J. Petra Company reports that investors now make up the highest share of home builders in 5 years. And you'll recall that we've had C.J. Petra Company founder Rick Sharga on the show a lot with me here the past few years. Some say that the smart money is waking up again. I don't know. Investor activity is steady, but it's not really that much. It only seems like a lot because the wannabe owner-occupant buyer has been priced out. So it's better to say that investor activity has been steady. Investors bought fully 1/3 of single-family homes this past summer, and that is up from 27% in Q1. I'll discuss that more soon. Hey, one thing that makes GRE different is that our show sponsors are here to supplement and benefit your specific investor activity. And another thing is that I use them myself. Thank God. We are not here to tell you about pneumococcal pneumonia or your moderate to severe plaque psoriasis. I don't even know what that stuff means. Freedom Family Investments and Ridge Lending Group. I very know what they're about. I'm a satisfied client with each of them myself, so listen in. Most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
I'd like to welcome in a new guest to the show. He is a real estate investment strategist that's been working in the media industry since 2001, and throughout the career, he's held the title of a local news reporter, podcast host, and producer for nationally syndicated companies like NPR. He's been in real estate nearly 20 years. Adam Schroeder, welcome to the show.
Thanks for having me on. I really appreciate it.
I'm looking for your read on today's real estate market, just the general landscape overall. Because, Adam, I've shared that national transaction volume is down about 25%. Appreciation is still there, although it's been slow. Rents are just steady. We do, however, still have this supply that is down among entry-level homes, something a lot of media articles broad brushstroke and don't understand. And really, it's still a valid question to ask. Even today, is there any better risk-adjusted return than income property that's bought right? So what are your thoughts on the overall real estate investing landscape?
Yeah, overall real estate investing, it's kind of like what you said, entry-level housing. I remember I saw a heat map. This was probably 5 or 6. This was pre-COVID. It was maybe even 7 or 8 years ago. It was a heat map that showed like new construction home pricing. And, you know, there was like 500,000 and up was just this massive chunk. And then there was all these ones that were under about 300,000. It was around like 6 or 8% or something like that. It was really, really small. If you look around, it hasn't gotten bigger. And so the question of inventory and availability and pricing, they're never going to talk about it on the national media because there is no entry-level home in Chicago, in New York, in LA. You're not going to find that. I mean, you're paying $200,000 for a doghouse in the backyard if you're there. And so we are finding the entry-level housing, but I think right now an oversupply of inventory in some of these markets is a very good opportunity for people if you're buying with the right fundamentals. If you're buying in an area that's growing and has good long-term, 8, 10, 15-year diagnostics, then if you're buying now with builder incentives and all of that, yeah, your year 1, year 2, year 3 appreciation may not be the greatest because of that oversupply. But if you look at what's happening now with construction starts in a lot of places, builders have gotten scared off. They're not really starting them now. So if you're buying new now, in 2, 3, 4 years, all of the inventory will be sucked up and there won't be new homes coming to the market. So you're going to be one of those people who has one of the newest homes in the area. More people are going to want to be getting in. And so your appreciation and rent growth is much more likely to be growing. So that's one of the things I love to look at is I look at what new home starts, what happened in the past, what was oversupplied. But now what cities aren't building? And if I know what cities aren't building, then I can compare it to, okay, well, there are some cities in California that aren't building anything. I'm not going to buy in California, but there are some cities in Minnesota, in Oklahoma, in Texas where they're not building anymore. And if it's landlord friendly and can cash flow and all of that, sign me up. I'm bullish on parts of the United States real estate market, not the whole United States real estate market.
It's been pretty well documented that parts of the nation are overbuilt, however, especially in Florida and Texas. And I brought up the point months ago, Adam, that if you buy, say, a new build income property in temporarily overbuilt pockets today, 5 years from now, looking back 5 years onto today, you could be like, yeah, I bought 5 years ago when some areas were actually overbuilt and I snagged a deal and the builder was even giving me incentives like my rate at that time because long term the demand is going to be there and that the absorption is going to be there. So it's about knowing what's happening and then identifying the right time in that cycle. In today's environment, some feel that DSCR loans are a better option for investors. And what that means, a debt service coverage ratio loan, is that you qualify for the loan not with your personal income, but instead with the property's income. Do you see more investors employing DSCRs?
We see a ton for a really good reason, and that is simply put, especially if you're utilizing these builder incentives, buy down rates on DSCR frequently outperform ones with conventional. Like some of the lenders we're working with, I look and let's say you're putting 4%. I looked at it this morning with an investor with 4% of purchase price towards your loan. On a DSCR loan, you're down to 5.49% on a DSCR, but conventional, you're at 5.75. That doesn't happen for the most part. It's just something that right now the risk profile of investors is allowing the rates to be either at or better than conventional many times. Plus, people love to put their properties in LLCs for protection, and they'll worry with conventional, oh, what if a due on sale clause gets triggered, even though it's really hard to trigger that? If you worry about it, well, why not just get a loan that's equal or better than a conventional that doesn't go on your, debt to income and can go straight into the LLC to begin with, and then your hands are clean the whole way through, and you're not having to worry about transferring title. I mean, honestly, my wife is about to murder me because I have some properties that were meant to go into an LLC 2 years ago that are not currently in an LLC. So,
Well, hopefully you'll live until the end of this interview. Well, tell us more about DSCR loans and maybe now you talked about the upside, maybe some red flags and some things to look out for, times when we would not want to employ that loan type.
a lot of it with the DSCR, you're looking at, like you said, they're not evaluating you necessarily. Now, you do have to show reserves. You do have to show that the property will perform on its own. But sometimes full doc loans with conventional can be the way to go because, like I said, in the past, it used to be that DSCR loans were 0.75% or a full percent higher than the DSCR was higher than the conventional. And so if you could get a 4.5 with a conventional versus a 5.5 on a DSCR, it's well worth the extra paperwork that might come with doing it to save yourself that money and really build up your cash flow. We are just in a very awkward time of investing where the investors for DSCR loans, the people who are buying those mortgages, are not the same people who are buying the Fannie Mae, Freddie Mac secondary loan market. And so they just have different risk profiles, which allows the rates to be different. So that's really the big thing is if you've still got your Fannie, Freddie slots, it's worth talking to your lender and saying, what would it look like if I did this loan? What would it look like if I did that loan? Where am I? But when it's all said and done, if you're really close or equal, I would almost always skew towards the DSCR to protect myself, go straight into an entity and keep it off of my debt to income ratio. Plus, on DSCRs, you also have the option, and we don't recommend this for every property or even for certain people, depending on risk profile, but you have the option to do an interest-only loan with 20 or 25% down, which allows you to do kind of what we call cash flow management, where people get worried about interest-only loans and say, well, I'm not building equity, I'm not doing this, not doing that. Well, you're not, but you can still put principal towards your loan every month, right? Like a principal interest loan, maybe you're throwing $200 a month of principal towards that. Well, with an interest-only loan, you can still put that $200 in. But what it means is if there's a month where maybe you have some repairs that need to be done or something like that, don't pay the principal. And on the interest only, you're still okay. On a principal and interest, if you can't pay that, if you just pay all the interest, they're still going to say, well, Keith, you're late on your loan, right? And so it gives you a little bit more flexibility, but it's not for everyone. It's not for every property. So definitely talk with lenders about that. But conventional loans don't offer that. DSCR loans can.
There's always opportunity in every real estate market. It's just identifying what those are and then ethically exploiting the opportunity. So we're talking about buying in areas that are temporarily overbuilt, utilizing DSCR loans. And another advantage in this market, which is an aberration, is the fact that new build properties, like few times in history, if any, actually cost less than renovated existing properties.
Yeah, I mean, when you can get into, an A-class neighborhood with 80% owner occupied, 90% owner occupied, and you're getting in for way less than the median cost of a home in the US. You're getting in we've got new builds in the 220 range on some of them, up to 400. which is still below the median cost.
Yeah, that's really good.
If you're looking to get into any A-class neighborhood or even B-plus neighborhood, finding a property that's $250,000 in those areas is tough. It's just tough. And so, especially because as pricing went up for everything with inflation, you can't do a cheap rehab anymore. If you're going to do a good rehab, you can't do a cheap rehab. I talk to our teams all the time and they're telling me, hey, I only spent $70,000 to renovate this property. And it's like, that is a lot of money. I know you're getting it out whenever you do the BRRRR and, or sell to an investor, but it's still a lot of money to put in to get there.
Well, then let's talk about identifying possible growth markets for long-term investing success. New build properties tend to appreciate better than rehab properties. And you know what's funny, Adam? I was just sharing this with my audience on a recent episode. I largely disagree with this long-time investing axiom in real estate that says appreciation is just icing on the cake. I think I know what they're saying. That doesn't help you out on a month-by-month basis, but we're in real estate investing for the long term. And long term, more of your returns typically come from leverage appreciation than they do on the cash-on-cash return from cash flow. So to me, appreciation is not just icing on the cake. In a lot of cases, it is the cake. And really, that's something that new build can offer more of.
Yeah, I mean, it's almost, especially in today's market, it's almost like cash flow is the icing on the cake. If you can get a property that, is in that really good area like we're talking about and is, maybe it's appreciating a little bit now, but it's very likely to appreciate a lot later. If you factor everything in, maintenance, vacancy, all of that, and you're making $100 a month, that's solid. If you look at it and if you're in those areas, if you appreciate 5% on a $300,000 property, let me tell you this, you're not going to make $15,000 in cash flow that year on that property. So if you look at the people who are really retiring on cash flow are usually the people who have 100, 200, 300 doors or something like that, and they play the law of large numbers. I don't want to play the law of large numbers personally. I want to have really good quality assets and have fewer of them and really work on having positive cash flow, but having the equity growth that allows me to pull money out tax-free and either buy more investments or utilize how I want in my life.
Exactly. If your property cash flows $100 a month and it's a single family home, some people say, oh, that's awful. You would need 100 of them just to get $10K passive per month. Now you're thinking wrong and you're oversimplifying it. Like to your point with the $300K home and 5% appreciation, that's $15K in 1 year. You're building equity that can be borrowed against tax-free, and you're building up that lump sum cash flow windfall down the road, if you will. And real estate pays 5 ways and cash flow matters, but it's only one of 5 profit centers and all that. So yes, we're so aligned on that one. Appreciation is not just the icing on the cake. It's substantially more than that. Well, I've got something to announce. Adam here is going to co-host, along with our own longtime investment coach, Naresh, an upcoming live virtual event, and it's called How to Scale Your Portfolio with Tenanted Cash Flowing New Construction Properties. And it aligns in every way with the trends that we've been talking about and that Adam and I have been identifying here. The event takes place next week. But first, tell us more about what you and Naresh will be speaking about at the event there, Adam.
One of the biggest concerns people have about real estate, and one of the things that can eat into your cash flow more than anything, is vacancy. I mean, vacancy can kill your deal whenever it's all said and done, because it's one thing if you're, break even or $100 a month positive cash flow, but whenever you've got a vacant property and you're negative $1,500 a month, that can hurt, that can hit the wallet. And so what we really love, if you can hit it, is a tenanted property that's new and is in a growing area.
Yeah.
And we've got that, thankfully. I mean, we've been able to work some really good relationships with national builders that have allowed us to get into, they were doing a lease to purchase option with tenants who wanted to buy their property but didn't have it saved up. And these people didn't exercise their option, but they've renewed their lease. So you can come in and buy a property that has them in place. It is a house that they wanted to buy. So how long are they likely to stay? Probably quite a while. They like the school district. They like the neighborhood. They like everything about it. You're coming in, you've got the builder incentives we talked about before, and you're just in a positive cash flow position already. Now we're in Texas, which I was actually, funny enough, earlier, right before this interview, I was reading about the states that are going to grow the most projected until 2050, and they expect Texas to grow by nearly 9 million people between now and I believe it was 2050.
Everyone's asking, when is it going to pass California as the most populous state in the nation?
Well, it depends how many people from California are part of that 9 million. We've gotten quite a few of them there as somebody who lives in Texas. And we're in the big cities too. We're not in the podunk Texas towns you think of out in, East or West Texas. We're talking Houston, Dallas, and San Antonio, which are 3 of the top, I believe, 15 largest cities in the country. We're getting some really good incentives. You can get up to right now 10% builder incentive. So a $300,000 house, you have $30,000 that you can use.
That's massive.
Yeah, you can get that money back after closing. We can buy your rate down. I mean, we have some people who have literally taken the whole 10% and put it towards a fixed 30 rate at 4.25%.
Wow.
They are locking themselves in at 4.25. Or we have some people who say, like we were just talking about, cash flow is not a concern for me. I'm going to take half my down payment back and I'm going to go buy another property because I'm only in this property for 10% now. And so they're able to be, roughly break even in a good growing area, and they can acquire a second property. So you're buying 2 properties without mortgage insurance for essentially a 30% total down payment. And you're getting your 10% back when you buy the second property. So it's just really incredible time. Like you said, we haven't seen a time like this before. We were able to get into the wholesale division of these builders and provide these incentives that I've personally never seen before. Some of our reps are buying these homes themselves. So we're putting our money where our mouth is. It's just a great time, especially like you were saying, these homes, the inventory, take advantage of the opportunity, right? And there's an opportunity that's presenting itself. And if you look at the long-term demographics of Houston, Dallas, and San Antonio, it's an arrow pointed up. That's what those areas are.
100%. I mean, it's almost as predictable as anything. There's never a guarantee, but continued population growth and obvious need for housing there is about as close as you can get. That's massive. 10% back, $380K purchase, $38,000 back at the closing table to use in discount point buy downs completely, or half on discount point buy downs and half to pocket and use on another property or use on your next vacation or whatever you want to do. That's massive.
Yeah, it's fantastic. And one thing I forgot to mention about Houston, it's one of the things I love that people don't think about, has the 3rd most headquarters of Fortune 500 companies in the country, behind New York and Chicago. So people don't think about that when they think of Houston, but I love to throw that out there because it's there. I love Houston. I lived there for 7 years. It's where I met Naresh, actually, and would happily move back there again.
Right. Houston has moved so far past the monolith of just having oil be the economic driver. So we're talking about tenanted new construction properties in pretty hot markets. Houston, San Antonio, and Dallas, ready for you to purchase with that 10% builder incentive. And these are in communities that are primarily owner-occupied. So they do have that high appreciation potential and that potential for solid rent growth. So on the live event, the webinar that you are invited to attend from the comfort of your own home, what you can do is just learn more about this overall strategy and why the time in the market is right for this. Learn more about those geographic markets themselves and then their drivers, and even see available new build income property. And the benefit of you attending live is that you can have any of your questions answered right then and there. You can sign up at grewebinars.com. And Adam, before I ask you if you have any last thoughts, that event is next week. It is Thursday, November 13th. At 8 p.m. Eastern Time. Again, you can sign up. It is free. Space is limited, so that's something that you want to do now at grewebinars.com. Any last thoughts, Adam?
Yeah, I will just remind people there's always a reason to buy real estate and there's always a reason not to buy real estate. And depending on which one you subscribe to, you can always find those opportunities or you can scare yourself off. So, find the right opportunities that are there for you and your investing style, and jump in, because if you look at what's happening right now, when rates start coming down, owner-occs are going to jump back in, and that tends to lead to prices going back up. Like Keith said, these are 85% owner-occupied areas, and you're setting yourself up for success. And if you do it now, you can always refi later if rates come plummeting down, right? So find the right areas, find the reasons to buy, and go for it.
This is a time when builders are really willing to give you a break. Take advantage of it if you possibly can. Adam, it's been great having you here on the show, and our audience looks forward to seeing more of you next week. Yeah, some real potential here. I'm rather excited for your future as a listener next week. Investors like DSCR loans since the qualification looks at the property, not you. And see, conventional loans are more for owner-occupants. They're fine. They work for investors too. But with DSCRs, besides their other advantages, they're a check on making sure your property is profitable. It is just your rent divided by your debt service. That's all it is. So for example, with a $1,000 rent and a PITI payment, principal, interest, taxes, and insurance, payment of $800, well then your DSCR is 1.25. Investors love them because there's no personal income verification, no W-2s, tax returns, pay stubs. There's no debt-to-income ratio bar for you to have to clear. Also, conventional loans often cap you at 10 financed properties, and DSCR loans have no such limit. So there's faster underwriting and easier approval. But with DSCRs, look out. I mean, there could be some higher fees, and you might have a 3 to 5 year prepayment penalty, but buy and hold investors often keep the property that long anyway. So grow your income streams with DSCRs, even when the W-2 world says no. And notably, DSCRs have absolutely nothing to do with Jabba the Hutt either. No sluggy concerns there. If you wanted a deal on a property today, here you are with these new build incentives that are really good, better than what most builders are giving. It's like, here's your chance. One reason that the builders are giving us a deal is because of the bulk of GRE buyers. This is for you if you might want one property or 14 properties. Load up with these up to 10% builder incentives, or just attend the webinar and learn more. We got into the wholesale division of these builders. We got them right where we want them. The properties are typically already tenanted, so plant your flag in the ground and call this the pivot point. This whole thing could be a bigger deal than the first man to walk on Mars. We'll see, though no man has walked on Mars yet. But you don't need to wait that long. Take one of your 30,000 days that you've been gifted in this life of yours, the 30,000 days you've been allotted on this earth, to win back some of your future finite time. It is next week, Thursday the 13th at 8 p.m. Eastern. It's also GRE's last event of the year, your last chance, a live virtual event where you can attend from the comfort of your own home or anywhere, and it's free. Registration is open now. Sign up at grewebinars.com. That's grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.